This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our first session together on this Chapter 3, dealing with mostly property income, we discovered that the basis of assessment is a simple one. We will look at the rental income received and deduct from that for the tax year any allowable expenses paid. We work on a cash basis. You also have to know how to apply the accruals basis because the taxpayer may opt to use that accruals basis instead of cash. And there is that situation, of course, if the rental income is big enough, and it has to be very big, in excess of £150,000, then of course the accruals basis is compulsory. So the main problem was making sure to read the question carefully as regards what is the basis for when it is received. Is it in advance? Is it in arrears? Were the amounts due actually received on those due dates? Or did we get that situation where something that might have been due to have been received on, say, the 1st of April wasn't actually received until after the 5th of April, and therefore that put it into the next tax year? In terms of things to learn, expenses were a problem area because we had to know what expenses would be allowable expenses to be able to be deducted from the rental income. And one of the expenses that we strangely said we might consider to be not allowable is this one: finance expenses in relation to our property income, principally the loan interest, the mortgage interest that you pay on the loan that you took out to buy or then improve that property that is now rented out. That interest payment, once upon a time, indeed, as we saw in that earlier note, it was an allowable deduction. But now you still get tax relief, but not as an expense. Instead, as a tax credit relief. And crucially, as we've seen in other issues before, it's tax credit relief at the basic rate of tax, a 20% tax credit taken on the finance expense for the tax year that was paid in that tax year, and that will reduce the amount of tax charge in deriving the income tax liability. Let's learn a little bit more now about this. As we said, up until 1819, finance expenses, which was principally the mortgage interest, were fully allowable expenses, and they would be deducted in deriving the property income assessment. But now we have this fundamental change that is relevant for residential property. This applies to residential property, not to commercial property, on how the tax relief is achieved for such finance expenses. Now, therefore, no tax relief will be given as an allowable expense. It's not an allowable expense against property income, but instead will be given entirely as a tax reduction in computing the tax liability of the taxpayer. And critically, this relief will only be given at the basic rate of 20%. And this is why they made the change. Because what it means, therefore, is that this change will therefore have no overall effect on the tax liability of a basic rate taxpayer. It doesn't impact on a basic rate taxpayer, but it will increase the tax liability of either a higher rate or an additional rate taxpayer. Well, why is that? Well, it's simple enough. If you're a higher rate taxpayer, under the old system, if you paid out finance expense of £10,000, that would reduce the net income assessment to include in the income tax computation. So we were directly taking £10,000 off the taxable income. A figure of £10,000 in that higher rate band would have been taxed at 40%, and therefore we were saving tax of £4,000. Now what happens? That expense is not deducted against property income. Your taxable income is £10,000 bigger. That £10,000 worth of extra taxable income is now being taxed in your higher rate at 40%. But the tax credit you then deduct is the finance expense paid, £10,000, but at this basic rate of taxation. And £10,000 at 20% is only £2,000. So you're only getting a reduction in your tax of £2,000, as compared to 4,000 under the old system. So that's why this was done. It meant that basic rate taxpayers were not disadvantaged by the change in the rule. But if you were a higher rate, and then even worse, if you were not would be worse to be an additional rate taxpayer, chance would be a fine thing. But if you were an additional rate taxpayer, then you're going to be paying more tax as a result. Because instead, as we just said, with a higher rate taxpayer, instead of eliminating income that would have been taxed at 40% and replacing it with a 20% tax credit, the additional rate taxpayer, instead of removing income that would have been taxed at 45%, you are instead giving relief at just 20%. In 21-22, our tax year, therefore, if a taxpayer incurs mortgage interest expense of $5,000, again a repeat on a residential property. One of the rules we'll come to later down here, but I'll show it now. The new rules apply only to residential property, but do not include something. We mentioned this a while back in the previous session. We deal with the detail of it. You can just see it creeping in at the bottom here, furnished holiday letting. We'll deal with that after this particular issue of finance expense, but does not include furnished holiday lettings. But it's residential property to which it applies. None of it will show as an allowable expense against property income, but it will instead achieve tax relief, tax reduction at the base rate of 20%, i.e. £1,000, £5,000 at 20% there. Okay, time for you to have a little go therefore. Simply enough, exercise. Compute the 21-22 income tax liability. So not now simply computing the property income assessment, but computing the income tax liability that contains that property income assessment. We've got Dora House here, has employment income, £60,000. That is non-savings. Rental income received, rental income, of course, there, that is also non-savings. Rental income received of £10,000. She paid, again, we're looking on a cash basis, received rental income 10, paid maintenance expenditure on the property of £800, therefore a perfectly allowable expense against your property income. And the mortgage interest, the loan interest charges, were £6,000. That £6,000 now, of course, will not be deducted from that property income, but will instead, once you've computed what would otherwise have been your tax liability, you will deduct a tax credit taken at the basic rate of 20% on that finance expense charge. And that will be a reduction in the tax liability. So put your income tax computation together. We can see we've only got non-savings income, so don't bother with both a non-savings and a total column here. You don't need it, it's all non-savings income. So we've got employment income 60,000, you're going to have property income 10,000 received, less the only expense paid that is an allowable deduction here, 800. Get your total income, get your personal allowance deduction to get your taxable income, and then proceed to tax at basic, and is obviously going to be the case here, some higher rate tax charge as well. And instead of that combination of basic and higher rate tax being the income tax liability, you will instead then deduct your tax credit, 20% of 6,000, so some £1,200 there, in deriving your bottom line income tax liability. So put that little calculation together, please. Pause at this point, and then we'll come back and review that particular answer. Okay, looking at the answer now, hopefully no problems for your good selves here. We firstly work out the property income assessment, which we knew to be 9,200, because the rental income received of 10 was reduced only by the payment for maintenance costs of 800. So your property income assessment, again, non-savings income, same as employment income, was to then be included within your income tax computation, along with the other form of non-savings, employment income. Get your total income at that level of income there. Total income the same as net income here. The personal allowance is available in full, and that gives you taxable income of 56,630. As we knew, therefore, we were going to be a higher rate taxpayer. So tax using the normal non-savings income tax rates. We've got our 37,700 basic rate band. The balance is in higher rate at 40%. But instead of that then being your income tax liability, now we give the credit in relation to the finance expense incurred. Taking that amount of finance expense incurred, some £6,000, and then taking the basic rate tax credit relief thereon. 20% of that, as we said, would be £1,200, reducing down our income tax liability to, as there, hopefully the right number, £13,912. Again, we've not bothered with any analysis columns on that one because everything, well, both sources of income were non-savings. Back to our note, and now as we've mentioned off and on through this session and the previous session on property income, we've got furnished holiday lettings. Now, furnished holiday lettings, the rules here are actually beneficial. If you're letting out a furnished holiday property, a furnished holiday letting, then you're going to get more generous treatment under the taxation system than if you're just letting out a rental property, a normal rental property, for someone for a 6-month period, 12 months, 2 years, whatever it might be. Because the idea is if it's holiday lettings, then this starts to represent more of a trade rather than just a business, because now work is involved. It's not just owning property and letting the money come in from that. It's a business, yes, but it isn't a trade. So what happens now is if it's holiday lets, well, again, we might have tens, dozens, many individuals, guests within our furnished holiday let during the year. And when anyone leaves before the new one comes in, there is work to do. Maybe there's other work during each day, indeed, changing bed linen or whatever it might be. But there is work to be done because this is a holiday let, is taking the place of someone, again, going into a hotel. So there's work to be done. And because it smacks of trading, we get, therefore, some of the benefits of what happens in terms of dealing with trading income as compared to just the property business income. So what are these special rules? As we've just said, the letting is treated as if it were a trade, again because there's more work involved. This means although the income is taxed as income still from a UK property business, some of the provisions which apply to actual trades also apply to our furnished holiday lettings, and the ones that we need to be aware of. Again, we do not yet know how to calculate them, but there are capital allowances, the way by which HMRC give tax relief for capital expenditure incurred, which we deal with in Chapter 5, are now available on furniture. So rather than the more awkward replacement furniture relief that we saw that would apply to just otherwise furnished lettings, if it's furnished holiday letting, then capital allowances will be available on all furniture that we buy. And what that means, and we'll see the detail in Chapter 5, is that basically you're going to get 100% allowance on the qualifying expenditure you incur in the tax year in which you incur that expenditure. So you're going to get immediate tax relief on the full amount of cost. That is clearly better than what was only replacement furniture relief and the restrictions that apply to it. Also, the income that we derive, though it's still classified as business property income here, qualifies as being earned income for purposes of pension relief. Now that again awaits us in Chapter 10. But there will be limits as regards the pension contributions that we pay into a pension fund as to how much of those contributions in any tax year will be allowable in terms of the preferential tax treatment that applies to pension contributions. Again, to be found in Chapter 10, but we've mentioned already about certain types of pension contributions, like the personal pension contribution, and how it would be treated the same as gift aid. We saw that back in Chapter 2. Make sure you recall that before you eventually get to Chapter 10. So this is a good thing, because what it's going to allow to happen is potentially for the taxpayer to have a greater ability to get tax relief on a higher figure than would otherwise be the case. And of course, as much tax relief as we can get can only be a good thing rather than any restriction. So the detail of it you'll see in Chapter 10, but again, this is another plus in terms of the property being classified as a furnished holiday let. And then a property can be a very valuable item. A valuable item indeed, such that when it is sold, there could be not just a capital gain, there could be a very substantial capital gain. And although we've not dealt with either the calculation of a gain nor the reliefs that apply to mitigate those gains, that's in our CGT section after we've dealt with income tax. But there are certain reliefs, don't matter now at the moment what they are, but there are certain reliefs that by the time you've dealt with CGT, you will understand the benefit that they provide to taxpayers. One of these is called Rollover Relief. There's a glorious name. Another one is called, it's actually Gift Holdover Relief. Should be in there the word holdover. So hopefully by the time you look at this, that word will be in. It's known as Gift Holdover Relief and Business Asset Disposal Relief. Now again, you might be worried about the issue of the word gift there. That I just said, and is probably 99% of all occasions when capital gains arises, because somebody sells a chargeable asset and makes a gain thereon by basically selling it for more than their allowable costs incurred. But what will also represent a chargeable disposal, as we'll discover in Chapter 12, is a gift. If you give an asset away, strange though it may sound, there will still be a capital gain to compute on that disposal if it is a chargeable asset. Now you might say, but there's no sales proceeds, so how could there be a capital gain? Don't worry, that is dealt with because we'd be provided with an open market value of the asset concerned. So we'd still have to compute a gain based on the market value, even though no cash has come to the person who gave that property away. But if it qualifies, if the asset or the situation qualifies for this gift holdover relief that we see here, then that would allow for the deferral of that gain to be available to the taxpayer. They couldn't exempt it, but they could defer the gain. Now again, the details of that, all the reliefs are in Chapter 14 indeed, within these study notes and lectures. So we'll see that later. But any relief that is available to a taxpayer has to be a good idea. Now, if it's just a normal property that you let out to a tenant for however many months, however many years there, then none of those CGT reliefs will be available to you on the eventual disposal of that property. So this is a preferential treatment for something classed as furnished holiday lettings, treating it as we would more a trading asset used within a business, because this, as we started with, this furnished holiday let does take on the appearance of trading rather than just a property business that is being run. So those are good things to have. Again, as ever, the profit or loss will be computed for our tax years on a cash basis, but losses may only be carried forward against future profits, not just from future property income, but from furnished holiday lettings. This is where it arose, that's where it will be relievable against future profits thereon. But then, of course, the question, and for something that you're going to have to learn at some point in time, probably closer to exam date, is you've gone on, or I've gone on about furnished holiday lettings. What makes a property a furnished letting, a furnished holiday letting? Where does that holiday qualification come in? And that's what we have here. The lettings, now, what are the rules? Must be either UK or in the European Economic Area. basically the EU plus a few other countries, you'd be told if that were the case. It's most likely to be a UK in any exam question. It's obviously got to be furnished accommodation, and it's made on a commercial basis. The letting is on a commercial basis here, with a view, obviously, therefore, to the realisation of profit. In addition, the further following conditions must also be satisfied. So again, prior to walking into that exam room, doing well today, that exam room there, you'll need to know them. Don't need to know them now. When it comes up in questions, you can go back to your notes and look it up. Some will stick, gradually more will stick as you practice. The only time you really do need to know that, short-term memory issue again, is before you walk into that exam room. So the accommodation in question must be available for letting for at least 210 days in the tax year. Again, the accommodation must actually be let for at least half of that time, 105 days in our tax year. No one person occupies the property. No one person or persons occupies the property for more than 31 consecutive days. If one or more persons do occupy the property for more than 31 consecutive days, then those periods of long letting must not exceed 155 days in the tax year. So you can't pretend that this is a holiday let. Like you've got students in your particular property. It's a student let. Now some might argue students are on holiday. I never would, of course, that's a ridiculous idea. But you can't therefore pretend that this is a holiday let. So if you have a situation where one or more of the same persons are occupying the property for more than 31 consecutive days there, and in total those lettings exceed 155 days, then it is not a furnished holiday let. You break that rule, it is not a furnished holiday let. So those conditions need to be satisfied. Now again, with practice as you will have, then you will get to grips with that. But again, don't bother now to try to learn parrot fashion those rules, unless of course now is very close to the exam date. I hope it's not, that we have got plenty of time for our studies to bring us to the point to which we can take that exam with confidence and succeed therein. So furnished holiday lettings, it's a good thing to have the property classified as a furnished holiday let because it gets a more generous taxation treatment. And we also get the situation there where, as we've said, that you're able to benefit from various CGT reliefs as well as income tax reliefs. Okay, that's your furnished holiday let. Now, another different point. We've thought about property income of you own second or more properties that you let out, and the tenants live in those properties as their property for whether short or long term, 6, 12, 24 months, etc. We then distinguish that type of letting with, as we've just seen, furnished holiday letting, where it's very much short-term occupation as people are there for a long weekend, a week, 2 weeks, whatever it might be. But of course, if we go over the 31 consecutive days, then that potentially might endanger the classification of the property as a furnished holiday letting. And there are those other conditions then to be satisfied. But it's always been a different property. You've got your place, the house that you live in, and then you've got these separate rental properties or rental property. What we're now talking about is actually renting out a room or rooms within your own property, your main residence, where you live. And if that is the case, then there's this thing called rent a room relief. So if an individual lets a room or rooms furnished in his or her main residence as living accommodation, then gross rents up to £7,500 per annum are exempt. So if you rent out room or rooms in your private main residence as residential accommodation, you take a lodger in basically there, this expression they might use, a lodger, someone who lodges in your house, that's where they live for the period in which they lodge, then in that situation, unless that rental income goes above £7,500 in the tax year, you're going to have no problem with HMRC. It will be exempt. Right. That's the very simple basic rule. How does it manifest itself? What do we have to watch out for in terms of an exam question? The exemption may be ignored. So to begin with, yes, we like the idea that £7,500 of our rental income is effectively exempt there. So if our rental income from renting out the room or rooms in our property is less than £7,500, so we let out and we get £6,000 worth of income, then that's less than 7.5, it is exempt. If we go down this route and we had, say, £8,000 of income, then the first £7,500 would be exempt. And on that basis, only £500 would be taxable. But what you're able to do is, if you choose, you can ignore. The exemption may be ignored. Now, why would you want to ignore an exemption of £7,500? Remember what it's doing. It's taking either your £6,000 or your £8,000 and reducing it by the relevant exemption. £6,000 of rental income is less than 7.5, so it's fully exempt. £8,000 of rental income, then we take the full exemption of £7,500. But why the taxpayer might ignore this, elect to ignore it, is if the taxpayer wants to generate a loss where expenses exceed income, or where actual expenses exceed £7,500. So I've got £6,000 worth of rental income there. If I've got expenses of £7,000, then income 6, expenses 7. That therefore, if left on its own, without the renter room relief, would create a loss. A loss, therefore, that could be carried forward and offset in the future against future property income. So you could generate a loss where one would not otherwise be worthwhile. And if, of course, your actual expenses exceeded 7,500, it's probably unlikely that that would be the case, but the examiners can write what they want. But if your actual expenses were more than 7,500, what would you rather reduce your income by? £7,500 or the actual expenses that are 8,000, 9,000, 10,000, whatever. You want to reduce your income by the biggest figure. So if the actual expenses exceed 7.5, then you're better off ignoring, electing not to have the renter room relief, not going for it, and just sticking with the normal rules. So if gross rent exceeds £7,500, the taxpayer may choose to assess as follows. Take your gross rent, less expenses, and that will give you your property income. Your normal rules. Again, the exam question will tell you what the rental income is, what the expenses are, and you will work out the property income assessment. Alternatively to that, we go with the renter room relief. Picking up again the gross rent, i.e. before deduction of expenses, and taking out the set figure of rent a room relief of £7,500, and that would therefore give you your property income. So you have the choice, which do you want to do? The election here for the rent a room relief must be made, or for our tax year 21-22 there, by the 31st of January 24. And once you do elect it, it stays in force until for a tax year you choose to revoke it. So good news, you let out room or rooms in your own main residence. The first £7,500 of your income will be exempted. If you don't want to use that renter room relief, then you don't have to use it. Why would you not use it? Either because the actual expenses you've incurred for the tax year are more than 8,000, but whatever the actual expenses might be, they might be more than the gross rental income. In which case, if actual expenses are bigger than income, you've got yourself a loss, and the loss therefore may be used in the future to reduce future property income profits. We have a little example here, example 4, where this time back to very specifically looking at property income assessment, and again for our tax year 21-22, and to state the due date for any relevant election. Obviously, it is to do with this rent-a-room relief. Barbara rents out a room in her main residence. Rent-a-room relief. Gross rents received, we're still working on the cash basis, it's received £650 per month, and annual expenses amount to £1,200 that were paid in the 21-22 tax year. So you've got the two ways of dealing with it here, the normal treatment, and you've then got the rent-a-room relief treatment. So over to you, therefore, have a little go at that. You can see the basis for it here, and we'll go through the answer together in a few minutes time once you've had a chance to look through that. Okay, well, hopefully it didn't take you too long there to establish the two figures of property income assessment, either using the ordinary calculation, where we simply look at rental income received less the expenses paid, and then comparing that with the election to take rent-a-room relief and have the first £7,500 worth of such income exempted. So our ordinary calculation, what were the rentals received? 12 months at £650 a month, so £7,800. That's the rent received, less the expenses paid, £1,200. So we have a property income assessment of £6,600. Alternatively, if we claim the rent-a-room relief, which I think you can see pretty clearly here, it's a bit of a no-brainer, I think we will. We have our gross rent again of £7,800. We ignore actual expenses and simply exempt the first £7,500 worth of that income, applying the rent-a-room relief. And that, of course, leaves us with just an assessment of £300. As gross rents have exceeded £7,500 and therefore there would be an assessment, we must elect for the rent-a-room relief to apply if she wants it. Barbara should elect for the alternative treatment in 21-22, that being the rent-a-room relief election, by the 31st of January 2024. It might seem like a strange date, that one, but for 21-22, you've got to pay your tax and submit your tax return by the following 31st of January. That'd be the 31st of January 23. So you basically got one more year to the 31st of January 2024 to say, you know what, for that tax year, 21-22, I'd like to do it this way, please. Okay, so they're the rent-a-room relief. So we have seen we've been renting out just normal rental properties, residential properties, to individual taxpayers for periods, extended periods of time. Normal let, 6 months, 12 months, 24 months. We've then seen what happens if we have furnished holiday lets, and because they start to take on, there's more a job of work involved here, therefore more like a trade, and on that basis, therefore, you're allowed the various beneficial treatments in relation to furnished holiday lets. We've also seen if you don't rent out a property, a separate property, but actually you rent out rooms in your own main residence, then the possibility of rent-a-room relief exists for you there, allowing £7,500, the first £7,500 of income to be exempted. We've got one remaining area in relation to property income to complete. The one that we said right at the very beginning of this particular chapter was one that we may not be familiar with, and that's where lease premiums are paid on the grant of a short lease. And what we mean by a short lease is 50 years or less, not more than 50 years. We said when we first introduced this that we're used to the idea that when a property is let out, when you grant a lease to a tenant, that there will be rental income that will flow in during the period of that lease. What we also have here is a one-off single premium that is paid when that lease is granted at the beginning of the lease period. So when a tenant takes on a new lease, he may be required if he wants to take the lease anyway, to pay a one-off premium, in addition to the normal annual rent. If the lease is for less than 50 years, or not more than 50 years, we're now talking about a short lease. And what that means that when that premium is received by the lessor from the lessee, part of the premium is assessed on the landlord as property income. The remainder is treated as a capital receipt. So as you might guess, the full amount of premium received is going to go through the taxation system. In our syllabus, we're only interested in the bit that is treated as income and therefore goes into your income tax computation. The capital gains component, that is not a part of our syllabus. But understand that both components, the income and the capital element, are dealt with within the taxation system. So how do we work out what is our amount of income receipt? And that means that we need to remember this little formula here, because the amount of the premium assessed as property income is P, the premium there, the total premium, multiplied by 51, which is one more than 50, hence our 50-year lease in terms of what short leases are, minus N, the duration of the lease, over 50. So that is the income taxable part of the premium received. Your premium multiplied by 51 minus the length of the lease there, over 50. That goes straight to the assessable premium figure. Another way of doing it, I only say this, is that because you sometimes see answers produced by the ACCA providers of examination material, the assessable premium may be computed as the full premium received less 2% of the premium for the number of the years of the lease less 1 there. Now, either way is fine. Again, maybe that second one is easy to remember as a line, but if you're at all more mathematical and you want to go directly to it, that's the one to learn. The premium multiplied by 51 minus N, the number of years of the lease, over 50 there. Right, let's have a little example just to illustrate what's going on before I then leave you to have a go at the one in the text there in the study notes. Right, if you can make a little note of this, therefore, we have our hero Aston received a premium of £70,000 when granting a 21-year lease. 21 years is not more than 50. This is a short lease. Therefore, a part of that premium received will be treated as income to be included on the income tax computation for the tax year in which it is received. So Aston received a premium when granting a 21-year lease. So Aston is the lessor to Villa, and Villa there, Villa is the lessee. And that was granted on the 1st of July 2021. Pause for due veneration of those two words, Aston and Villa there. As well as Aston receiving the premium of £70,000, Villa was also required to pay a rent of £20,000 per annum, payable half-yearly in advance on the 1st of July and the 1st of January in each year. And what we've now got to do is to establish the property income assessment. Well, I suppose the bit that we already know how to deal with is in relation to the rental income. We know we work on a cash basis, rent received, less expenses paid. No information here about expenses, but if there were any, we'd just pick up the ones paid within the 21-22 tax year. Villa paid rent of £20,000 per annum, payable half-yearly in advance. Now then, the lease was granted on the 1st of July 2021. Therefore, that first lease rental payment Now, that's half yearly on 20,000, so that's £10,000 therefore for each half year. That would have come in on the 1st of July 21. Moving forward within our 21-22 tax year, there's one further receipt date, the 1st of January 22. The next receipt date will be in July of 22, and that's in the 22-23 tax year. So again, there are two due dates when we presume, without any other information to the contrary, that those amounts were paid by Villa to Aston. So we're going to get £20,000 as the cash received. So the rental income assessment is £20,000. That's the cash the rent received. If, as I say, there were allowable expenses paid for during the period from the 1st of July 21 through to the end of the tax year, the 5th of April 22, then those would be deductible from that income figure. But the new bit now is dealing with that premium. How much was the premium again? The premium received was £70,000. So the premium received, 70,000, multiplied by, then our equation to remember, 51 minus n, the number of years of the lease, well, it was a 21-year lease, over 50. And that, therefore, will establish for us quickly, easily, what the income element of the premium received is going to be included on the income tax computation here for 21-22, the tax year in which the premium was received. So 51 minus 21 would be 30, 30 over 50, well 30 over 50 is what, 60% of 70,000, and that's going to be, do check my maths there, £42,000. So what we would have in the 21-22 tax year for Aston, our particular client, the lessor, is rental income within the property income assessment of £20,000, less, as we said, any expenses paid within the tax year. But not only the rental income is assessable, also the income element of the premium, and that is £42,000. The capital element is outside your syllabus. You do not need to know what to do with that. 42,000 will also be included on the income tax computation of Aston the lessor. Okay, with that in mind, therefore, you've got a little example there, example 5 to sort out, where again we want the property income assessment. Again, make sure you read the question carefully. Do you want the property income assessment, or do you want the taxable amount of the premium that was received? Because the property income assessment combines both, as we've just seen, the amount of property income, the rental income, that is assessable, and also the premium. Bill grants Richard a lease to a shop on the 30th of June 21. Annual rent £5,000 due on the 1st of July 21. So it's a single one-off payment each year, annual rent £5,000 due on the 1st of July 21. The period of the lease, 20 years. The premium received, £60,000. So over to you, therefore, now. You've seen what we've done with that class example. Establish that property income assessment, please, for Bill, again, for our 21-22 tax year. So pause now while you have a go at that quick exercise. Okay, well, again, let's just check to see whether or not you've got everything right as regards this little example. Again, we needed the overall property income assessment, that we need both the rent received and, again, as in my class example, if there had been any expenses paid, that, of course, would be deducted from the rent received. It's a full annual figure. It's due there annually in advance. Again, therefore, one such due date fell within our tax year when the rent would have been received, so £5,000. The premium received was £60,000. It was received on the grant of a 20-year lease. So using our equation, the premium amount multiplied by 51 minus n, the number of years, 20 over 50 there, multiply it through, and all being well, that comes out to £37,200. So the overall property income assessment, £42,200 there. Again, otherwise, if you wanted the alternative way of doing it, so that I'm only showing it so you don't get confused if you see an answer done this way in terms of any other material that you may use. It may be shown as 60,000, the premium, less 2% for each year of the lease minus 1. It's a 20-year lease minus 1. Therefore, 2% times what would be 19 would be 38%, a reduction of 38%. So 62% of the 60,000 would be assessable, and that would again give you 37,200 there. Again, either way is absolutely fine. Just going back to our notes, and in our class example, we dealt with the situation for the lessor, here, Aston. There is a further issue as regards the premium that's been paid by Villa, as regards what can we do with that in Villa's hands. So back to the study notes, and you normally see this situation where it's not just an individual taxpayer who happens to pay this premium on the granting of a short lease, and that leasehold property is a property in which they live, it's residential. It tends to be set in a business context, and so therefore it tends to be a commercial property. So we now see that there may be a trading profit deduction for traders who've paid that premium. So we're a trader, so we've got trading income. This will be a deduction against that trading income. Has paid a premium for a short lease. He may deduct the following annual amount. So over the period of the lease, it will be an annual amount each year to deduct against his trading profit. In each of the years of the lease in which the property is used in the trade, this is in addition to any rental cost incurred. Obviously, the rental that you incur, if it is a business there, then that will be an allowable deduction against your trading income as well. But what we do now, we pick up on the top line our property premium income assessment. So whatever amount of the premium received we have classified as income, that income component of the premium received is then divided by the number of years of the lease, the life of the lease. And that will give us our per annum, our annual deduction, payable in each of those years. So if I take you back to the example that we had, Aston had received the premium of 70,000 on what was a 21-year lease. Villa, therefore, had paid out on the 1st of July 21, not just the first rental payment, but also had paid out this £70,000 premium. Now again, as a trading income figure to be assessed as trading income, such as you'll see in the next chapter, chapter 4, we would be deducting in relation to the accounting period of this trader the amount of rental payable in relation to the accounting period. And of course, a trader has got the right to prepare accounts to any date they choose. So we'd just be working out for the accounting period in which that agreement was taken up. They took Villa took the property from the 1st of July 21, this commercial property. What therefore would be the rental payable in that accounting period, and that would be the allowable deduction against trading income. But there will also be, in terms of the amount paid, an annual trading profit deduction that you can also take here. Now, if we go back to our note, the property income assessment on the landlord, divide by the life of the lease, the number of years of the lease, and that is the annual, the per annum figure. For each year of the lease, that amount of deduction is available against trading income. So let's just see what we had. What did we work the property income assessment to be? There it is, 42,000. So for the lessee, the annual trading profit deduction will be, what was the property income assessment, the amount of the premium assessable as income, it was 42,000, divided by the number of years of the lease, that was 21 years, and that of course will give you £2,000 per annum. So in each full year of the lease, in addition to any rental payable, I think it was the £20,000 a year there, we're going to have £2,000 as a further annual trading profit deduction. Now, of course, in our tax year, 21-22, we can see here it was the lease was granted on the 1st of July. So it would now depend as regards how much of that £2,000 per annum was going to be deductible in the accounting period for Villa in which that lease was granted and the premium was paid. If, for example, that Villa prepared accounts to the 31st of December in each year, let's assume Villa, the lessee, produced accounts to 31st of December, then the amount of the lease period in the accounting year ended, the 31st of December 2021, would be from the 1st of July 21, when the lease was granted, the start of the lease, through to the 31st of December 21, the end of the accounting period. Now that is only a period of 6 months. So if you were dealing with working out the trading income assessment for our lessee, Villa, in relation to this premium that has been paid on the 1st of July, then for the year ended 31st of December 21, if again the lessee prepared accounts to the 31st of December, then from the start of the lease period, 1st of July, to the end of the accounting period in which the lease was taken on, that's 6 months. So therefore, you take 6/12 of that 2,000, and that would mean for the year ended December 21, £1,000 deduction would be available. For each then full year, so from the year ended 31st of December 22, you'd be deducting your £2,000 per annum. So the individual receiving this premium and the rent was indeed an individual and assessable in relation to the tax year. So we looked at what was received in the tax year and assessed it in 21-22. If we're now dealing with the lessee, who is a trader there, then we're trying to work out the trading profit assessment to assess for our 21-22 tax year. And that's going to be based on a certain accounting period of profit. But that's an adjustment of profit exercise, which we do in the next chapter, chapter 4. But in relation to this, if, as you must be told, the date to which the lessee prepares accounts, if here it was the 31st of December, lease acquired 1st of July, next 31st of December is December 21, 6 months of the lease period falls in that accounting period, so if it's £2,000 per annum, which it is, that's £1,000 deduction in deriving the trading income assessment for the lessee for his or her year ended the 31st of December 21. Okay, just one final thing to look at now, very briefly, having sorted out the property income, about ISAs and about some national savings and investment account interest. ISAs we saw back in chapter 2 in about the first lecture about exempt income. And ISAs have for many years been the most common form of tax efficient investment. Why? Because income is free of income tax. What you didn't know, but we tell you now, is that disposals of investments within an ISA are free also from CGT. Now, what are you going to see within an ISA? Basically, components of an ISA, as shown here, are twofold. Cash in a bank account in some sort of financial institution, but cash held within an account which earns interest. Now, when that's sold, Well, you don't sell cash, do you? When you close that account or whatever you take your cash out, there is no capital gain. But the other component, stocks and shares, that listed anywhere in the world. So stocks and shares. Now, when stocks and shares are disposed of, they may indeed be a chargeable disposal of a chargeable asset, and therefore a capital gain may indeed arise. But that gain would be exempt, because disposals of investments like stocks and shares that are within an ISA are free from CGT. There's no minimum holding period here. You can keep your money in or the shares in your ISA for as long as you like. Withdrawals can be made at any time. What we've seen, and we mentioned back in Chapter 2, that when the savings income nil rate band and the dividend income nil rate band came in, that removed one of the main benefits to most taxpayers of investing in an ISA. Because again, back in the day, the level of investment within an ISA was not very great, and therefore the amount of interest you get on it wouldn't be very great either. In which case, if you're just a basic or even a higher rate taxpayer, you get a savings income nil rate band of either 1,000 or 500. And if you've got stocks and shares, then you've got 2,000 dividend income nil rate band. Now, it would still, of course, give advantage to taxpayers with larger amounts of such income for taxpayers and for taxpayers selling shares where they've already made full use of their annual exempt amount. Now, two issues there. If you've got very, very large amounts of savings, interest income, then you might very well be a higher rate taxpayer, and that may equally mean, well, it will equally mean that only £500 worth of that savings income, your interest income, will be covered by the savings income nil rate band. And we may have many thousands of such pounds. Silly, therefore, not to take advantage of the use of an ISA that would exempt all interest within that ISA. And the amounts that you can put into an ISA have been increased in sort of relatively recent years, at least in terms of the history of ISAs. And you've now got an annual subscription limit of £20,000 per tax year. So if you've got enough money to be able to invest, either in an interest-bearing account or in terms of shares, knowing that any dividend income from the shares or interest income from the cash deposits is going to be exempt, then year on year, 20,000, 20,000, 20,000, you can build up a significant amount of capital from which the income will be exempt. It would be silly not to use the benefit, therefore, of such an ISA. And in relation to shares, not that there's a guarantee of it, but if you do manage to sell those shares eventually at a capital gain, then because they've been held within the ISA, that gain will be exempt, something that wouldn't happen if they were held individually by you outside of the framework of an ISA. Also, again, they're making use of their annual exempt amount. Have you set taxpayers where they've already used it? If you were making just a small amount of, a relatively small amount of gain each year, then in the same way as we have a personal allowance, a level of tax-free income to use within the income tax computation, on the CGT computation, as you'll see in Chapter 12, there's a level of tax-free gains, and that's still running as it was for last year at an annual exempt amount of £12,300. So if your gains on the shares that you sold and you didn't have any other assets were never exceeding your annual exempt amount, then having those gains exempt doesn't really matter because they'd have been exempt anyway by the deduction of your annual exempt amount. But if you're going above that, again for holders of far more bigger shareholdings, then again, using the ISA, it would be silly not to. If you've got that spare £20,000 each year to invest, where you go, put it in your ISA there. The other main point here about national savings, we did refer in our list of exempt income, not just to ISAs, as we have seen there, but also to national savings certificates. And the national savings certificate income was exempt. Again, national savings, these offer a variety of products, some of which are tax-free, and our favourite one, national savings certificates. But we did say that if we had national savings and investment accounts, then we may see that that would create taxable income. And these products, which you most usually see as the national savings and investment accounts within an exam question, would be an easy access account, or a direct saver account, or an investment account. The income is received gross without deduction of tax at source. Well, all such interest is. And of course, that means that that type of national savings and investment account interest will be taxable as savings income, but the disposal of national savings certificates, that is exempt. Okay, at last, we come to the end of chapter 3 there. Not as daunting as was chapter 2, but what we've done is to put the detail in behind what was just a single inclusion on the income tax computation back in chapter 2. That was the property income. We can now see where that property income assessment may come from and the basis of that property income assessment. Well, the next 5 chapters, starting next with chapter 4, is going to look at traders, unincorporated traders, sole traders, eventually partners in a partnership there, and look at the way in which they are assessed. All of that and more coming up next. See you next time.